We've all seen those headlines that just make your stomach drop, right? Market plummets, billions wiped out. It feels like this random, unpredictable disaster. But what if it's not? What if every single major crash, from the Great Depression all the way to the dot-com bust, actually followed a surprisingly predictable script? Well, today, we're going to pull back the curtain and look at that very script, page by page.
So let's just get one thing straight right from the start. This isn't some wild speculation. It's a hard truth. As investor Mark Tilbury puts it, crashes aren't an if, they're a when. They are a built-in, totally unavoidable feature of how the market works. But this is the question that trips everyone up. When you hear that $100 billion was wiped out in a day, where did it go? Did it just poof, vanish into thin air? Is someone hoarding it in a secret account? The answer, well, it's way stranger and actually a lot simpler than you probably think. All right, so let's tackle this big mystery head on. To really get a grip on where the money goes, we have to first understand what that money actually was in the first place. You see a number like this splashed all over the news. It's huge, it's intimidating, and it feels incredibly real, doesn't it? But that number is also really, really misleading. And to understand why, we need to forget about stocks for a second and talk about something, well, something completely different. So yeah, forget stocks for a minute. Economist Richard J. Murphy has this great analogy. Imagine the entire UK supply of baked beans is our stock market. Stay with me here. So you've got 1 million tins of beans, and the supermarkets are selling them for £1 each. That means the total value, or the market cap, of all the beans in the country is £1 million. But here's the thing. That value isn't cash sitting in a bank. It's based entirely on an expectation, the price everyone hopes you'll pay. And then a price war kicks off. All of a sudden, every single tin of beans in every store gets a new price tag, ADP. Now, this is the crucial bit. Not a single tin has been bought, sold, or moved. The physical reality is identical. The only thing that's changed is the little sticker on the tin. And just like that, our bean market is now worth £200,000 less. So where did that money go? The answer is absolutely nowhere, because it was never really there to begin with. And this is where it all clicks. The lost money was never cash. It was just a measurement of hope, of confidence, of what people thought those beans were worth. When that confidence drops, the valuation drops. No real money was destroyed, because no real money was created in the first place. It was just an idea of value that changed, not an actual bank balance. Okay, so if a crash is really just a dramatic repricing of hope, what causes that hope to just shatter so violently? Well, it turns out it's not random at all. History actually shows us a blueprint, kind of a recurring recipe with the same 4 toxic ingredients. And here they are. Think of these as the 4 horsemen of a market apocalypse. You've got rampant speculation where prices just totally detach from reality. Then you have regulatory shortcomings, where basically the guardrails are missing. Add in a new, poorly understood innovation that feels like it's going to change the world. And finally, fuel the whole thing with a massive buildup of debt. And you can literally see this recipe play out again and again throughout history. In the 1600s, it was rampant speculation on, of all things, tulip bulbs. In 1929, it was a total lack of regulation on borrowing money to gamble on stocks. In 87, a poorly understood innovation called portfolio insurance. And in 2008, a giant mountain of debt built on incredibly risky mortgages. The names and dates change, but the story, it always rhymes. Now, what's so wild about this quote is when he said it. This was President Hoover just 6 months before the crash of '29. It just perfectly captures that feeling of overconfidence, that irrational exuberance that's a hallmark of every market peak. Everybody thinks they've hit a permanently high plateau. Let's just zoom in on that poorly understood innovation ingredient for a second. In 1987, Wall Street introduced something called portfolio insurance. It was sold as a seatbelt for your investments, right? An algorithm that would automatically sell a little bit if the market dipped, protecting you. But the fatal flaw was this. When everyone's seatbelt pulled at the exact same time, it didn't save the car, it drove it straight off a cliff. Which, of course, brings us to right now. Are those same 4 horsemen riding again? Are those historical warning signs flashing red today? Well, let's take a look at the data. So this is what's known as the Buffett indicator. It's basically a gut check that compares the total value of the stock market to the country's entire economic output, its GDP. Warren Buffett himself says anything over 100% means the market's getting a bit expensive. Well, right before the dot-com crash, it hit 115%. Today, it's sitting at 220%.
Next up, let's talk about concentration. Think of it as having too many eggs in one basket. Back during the dot-com bubble, the 10 biggest companies made up about a quarter of the entire S&P 500. Today, that number has ballooned to 40%. That means the fate of the whole market is tied to just a handful of giant companies, which makes everything a bit wobbly.
Okay, now for the price tags. A PE ratio is just a fancy way of asking, how much are people willing to pay today for $1 of a company's profit? Historically, about $16 was the average. As you can see today, we're paying nearly double that for the average stock. And when you look at the big tech companies that are driving this market, well, the numbers just get kind of nuts. So what's the common thread here? The Buffett indicator, the market concentration, those sky-high PE ratios, what are they all pointing to? Well, it looks a lot like ingredient number 3 from our historical recipe, a massive collective bet on a new and poorly understood innovation. In 1999, it was the internet. Today, it's artificial intelligence.
Okay, so that might all sound a bit scary, and the warning signs are definitely there. But the goal here isn't to predict the exact day of a crash. That's impossible. The goal is to be prepared for when it inevitably happens. So, what does a smart playbook actually look like?
First things first, diversification. If you feel like your investments are maybe a little too concentrated in those big US tech stocks, you don't have to panic and sell everything. Instead, you can just start directing your new investments somewhere else, into international stocks, smaller companies, or emerging markets. It's all about rebalancing your risk.
All right, the second part of the playbook. This might be the most important part. It's all about psychology. A crash is a test of your nerve, your gut, your emotions. They're all going to be screaming at you to sell. The key is having a plan that overrides that panic. If you know why you invested in something, it's easier to hold on. And even better, if you've got some cash saved up, you can completely flip the script and go shopping when everyone else is running for the hills. And this right here, this is the ultimate mindset shift. For an investor who's prepared, a market crash isn't just something to survive, it is a massive opportunity. Those moments of maximum fear are almost always the moments of maximum opportunity.
So, that's where we'll leave it. We've seen the historical patterns, we've looked at the warning signs today, but honestly, trying to predict the exact day a crash will happen is a fool's game. The real work is in the preparation, because a crash is coming. The only question that really matters is what are you going to do about it?